Stocks and bonds turn bullish. What does it mean for you and your money? That's coming up on 3 Minutes on Markets and Money. So two things I want to get into today is talk about this rally in the stock market. Is it sustainable? And take a look at what's happening with bonds, both of them giving some pretty bullish signals, actually. Let's start with the stock market. Last week, we suggested that the market had gotten a little bit extended, broken above the 50-day moving average, and what we needed was a retest, a pullback of the market that would test that 50-day moving average without violating it. That happened on Friday. Now, importantly, what we're seeing here is that the market did pull back to that 50-day moving average. Now, this is good news from the standpoint that now is turning that previous resistance into support. At the same time, this downtrend channel that we've been in since really kind of the March peak, we've broken out of that as well, and we've started building a row of higher lows. And this is important here because now we're starting to see for the first time some kind of bullish action within the markets. As we have our MACD buy signal in place, that's been helping support stock prices. And we've continued to have this very nice bullish trend going on in the markets. Now, the bad news about this is that what you would have expected from such a deep oversold condition is a much more kind of vicious rally in the markets like we saw back in March. This has been much more subdued. It's eating up a lot of that oversold condition that we had. In fact, stocks are getting back to more overbought conditions short term. So again, this market does have some more legs to go here in terms of its advancing. Could work its way up to around 4170 on the S&P 500. So there is upside here. But again, we're moving kind of so slowly in this advance, it's eating up a lot of that good news that we've seen from both earnings, and hopefully we'll see a little bit better news coming up in some of the economic data, because a lot of that data has now gotten fairly negative. Outside of that, this week, lots of activity going on. We really get into the heavy breadth of earnings season this week and next. Also on Wednesday, we have the Federal Reserve announcing their 75 basis point hike. We'll be watching their meeting commentary about how aggressive they're going to be. That's going to be what's really going to be driving markets on Wednesday. Then Thursday, we have the first estimate of second quarter GDP. Did we slip into a recession in the second quarter? Well, we'll get that first number on Thursday. Now, I suspect that number will be above zero because it's just a kind of a general consensus of all the estimates out there. And a lot of the big economists are still above zero for the second quarter. Atlanta Fed currently suggesting a negative growth rate, likely to catch up with that later in the quarter. But we could see a positive above zero print on Thursday. So we'll see. That could help buoy some stock prices in the short term if the fear of recession is taken off the table, at least temporarily. But let's take a look at bonds, because bonds are also sending us a very interesting story. The one thing that has been really interesting as of late is watching what's going on with yields. Yields are telling us a lot about what's expected in terms of economic growth. Yields, the bond market adjusts yields to reflect economic activity, inflation, these type of things. What yields are telling us right now is that both economic growth and inflation are likely slowing more than expected. And what we've watched over the last week is yields have come down. We're now testing very important support here. If we break below 2.65% on the 10-year Treasury, we could see a fairly sharp decline in interest rates in the short term. Now, importantly, interest rates, this move down has gotten interest rates fairly oversold here. Now, that's kind of an overbought condition for bonds, so wouldn't be surprised to see rates pick up here a little bit before going lower. But what yields are starting to tell us is that the economy and inflation have likely peaked, and we'll likely see slower economic growth coming, which is going to push yields lower, particularly as the Fed continues to aggressively hike monetary rates. So not only are we getting a bit of a bullish signal on stocks temporarily, because we're starting to see the dollar weaken here a bit, and potentially there's hope the Fed's going to pivot. Bonds are also being bullish about suggesting that the economy is going to slow more than expected, inflation's going to come down, and the Fed's going to over-tighten policy. So we've got two kind of competing theories here for the markets. We'll have to wait and see which one's right. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here next time.